Welcome to today's presentation. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategies Australia. Today's topic, how the US taxes Australian superannuation accounts in 2026, a practical framework. So we're going deeper into this topic than what we have ever done previously. Of course, please note today's presentation does not constitute personal financial, tax, legal, or investment advice. You do well to consult with your specialized cross-border financial advisor if that is indeed what you are looking for. Before we get into things, a couple announcements. I should mention I've got over 100 videos up on my YouTube channel dealing with almost every topic that you could imagine to do with living between these two countries and organizing one's financial life. A little bit about me and how I came to be running a cross-border wealth firm. Essentially, I was born into it. I'm a tri-citizen of Australia, the US, the UK. Completed my undergraduate studies at the University of Queensland in IT and business management, then became a corporate financial analyst in the San Francisco Bay Area, where I did that for about 5 years before I saw the light and realized what I was called to do was to be a financial advisor. And that's because I like to think I have a gift in helping people connect dots and identify strategies forward to enhance their overall life and well-being by making use of their financial resources to the utmost ability. There's further detail here. I'm also the founder of the Global Financial Planning Institute, so I'm the guy that trains other financial advisors on how to do cross-border advisory work. We just had Charles Schwab this morning speaking on their cross-border facilities, not just Australia, but around the world. Just as one example, actually, we have a presentation next month from Moody's Tax for GFP members. But anyway, that's going into more detail than is necessary about the GFP Institute. Here you see three profiles of some clients, some types of clients that we work with. So there's the Australian business owner, the high net worth Aussie expat family, and the American family or individual that's relocated to Australia. Essentially, as I said earlier, we're delivering superior financial outcomes for them than what they would be able to attain by themselves. It's also worth mentioning at this point that I am, to my knowledge, the only financial advisor who is licensed in both Australia and the US. So I'm an authorized representative with a firm in Sydney, IMFG Financial, and I'm also the owner of Arete Wealth Strategies, a US wealth management firm. So we can do both sides of the Pacific. With that said, let's get into today's presentation. So firstly, we'll be talking about the issue, framing the problem, and why is it that the IRS has such an issue in figuring out how to tax Australian superannuation. Then we get into the nitty-gritty of the two major ways in which super is thought to be taxed, either as a foreign grantor trust or as an employee benefits trust. Taxation across the account life cycle from contribution, growth, distribution, key 2026 updates and policy developments, particularly Division 296, which came into effect on July 1st of this year, Payday Super, which also came into effect, and a change in the transfer balance cap. Next, strategies for the distribution phase. Actually, that's an interesting slide, because in that I'm actually saying what isn't a strategy. The options are even less appealing and flexible than what you might think. Lastly, some compliance pitfalls before we move on to practical framework. All right, before that, I will note what I've always done is entertain chats throughout. So rewarding those people for showing up here live today. Thank you for spending part of your morning or evening with me. David Smith asks, can you share the link to the YouTube channel? I certainly can, because I keep that as a short code right there, David, that is now available to. Jenny asks, is anyone else hearing a lot of echo in the sound? That's peculiar, why there would be a lot of echo. I haven't come across that before. Let me look at my audio settings. I'm using a professional microphone, so I'm not sure why That would be Robert Webster. Sounds fun. Okay, thank you, folks. Thank you. It's always nice to hear that others are hearing me just fine. I've invested a lot in a good quality setup, and so it's troubling to hear that someone's hearing echoes. Okay, yeah, that could be it, actually. Some people do log in multiple times, and that's a possibility. Yeah, thank you, Peter. Good to see you, Peter. All right, so let's carry on. So, Australian superannuation exists in a codification void that exposes expats to double and triple taxation. Now, the triple taxation is a pretty unusual phenomenon, but it is a possibility. So, the codification void, the issue that we've got is that the word superannuation appears nowhere in the Internal Revenue Code. So, if anyone recalls from my April presentation when we were talking about the mirror opposite of this, namely, what does the ATO make of US retirement accounts? The IRS has returned the favor. There is no mention of superannuation, and they need to make sense of superannuation through US tax laws. They look at superannuation and they say this is not a qualified retirement account as we, the US, think of it. This is something different. In fact, the way most practitioners think of superannuation, tax practitioners think of superannuation is it's some kind of foreign trust, which is how the Australians think uh, of the US retirement accounts. So in the tax treaty, we should know that the treaty was written before superannuation came into existence. So it's not dealt with in the treaty either. And then, of course, Article 1, one of my favorites, I've got a screenshot of it that I share with clients. Maybe I should get it framed and put on my wall here. But what the savings clause says is essentially if the US has a double income tax treaty with another country, then the US individuals, the US tax residents, are saved from any benefit that they may have enjoyed from that tax treaty. In English, that means American tax residents really don't have to worry about the tax treaty because it doesn't apply to them. Any benefit they may have gotten is eviscerated by this savings clause. So you can see down here in the bottom left, the result of that is you get situations where, especially with superannuation, where there's double taxation involved, and there's a slide dedicated to that, why the double taxation happens. And it's to do with US tax laws and how foreign tax credits are granted. And the foreign tax credit is granted to the individual or the entity that's paying the tax. And with superannuation, what's worth knowing about super is the contribution tax that is paid. Notice I'm not saying you pay it, it's your money, but technically it's not you paying it, it's the superannuation fund. And so that's where things get, one of the ways in which things get tricky on the US side is the US looks at that 15% contribution tax, maybe more than that, if you add up Division 293, which is a bonus 15% tax for higher income earners making more than 250,000 Australian dollars. So they pay 30%. Well, it's technically not the taxpayer paying that tax, it's the super fund. And so we enter a situation where there's double tax, and then with the 293, possibly a triple tax. All right. Somehow that has oh, thank you, Mike. I was just saying something. I saw a chat and thought to myself, somehow that has generated a question, which it may well have. Thanks, Mike, for letting me know the sound is good. Okay. US tax treatment hinges entirely on how one superannuation fund is characterized under US principles. Now, if you asked my clients, they would tell you that I've been at pains to communicate the point contained here on the next slide. I'll come back in just a moment, but essentially, the worst kind of superannuation account you could have if you're a US tax resident, namely you're in the US, one, you're a US citizen, two, or you are a US permanent resident holder who has yet to submit their I-407 form, then you're a US tax resident. If you hold a self-managed superannuation fund, that is just very bad news that you want to unwind that, move that over to an APRA regulated retail or industry fund where your life is going to get a lot simpler if you do that. However, there could be consequences merely in doing the rollover, and that could be deemed a distribution event in itself. So Hopefully that's not your situation. Next test. Did you have personal contributions? Meaning, did you, quite aside from the 12% superannuation guarantee contribution, did you perform some sort of electronic funds transfer over to your superannuation? Because heavens forbid we're not writing checks in this day and age, but did you add additional money to top up your concessional contribution or make a non-concessional contribution? If you did, and your total personal contributions exceed 50% of the account balance, bad news. You're looking at a foreign grantor trust. Or if you retain broad investment authority, what does that mean? That means lots of individual fund options that could see you get into strife also. So I think the safe way to navigate this would be if you're with, say, a fund like Australian Super in their high growth option, and you've contributed less than 50%, you're in an APRA regulated fund. You've got a whole bunch of other members in there, so you would not fall foul of this highly compensated executive exception. I'll come back to this slide in a minute. You don't have a ton of choice over your investments. You're playing it pretty safe. Okay, so let's come back here. Here are the two types of treatment that the US has. You've either got your foreign grantor trust or you've got your employee benefits trust. And the difference here is on is really when the tax is assessed. So the foreign grantor trust is taxed as follows. Contributions into the trust are taxable income, as they are also with the employee benefits trust. So taxable on the way in, taxable during your income earning years. So as the superannuation account grows in value every year, you've got what's called a mark-to-market taxable event. You need to add that growth onto your US 1040 and consider that growth. It's not taxable in Australia, or it is actually, excuse me, at 10 or 15%, but it's going to be taxed at a much higher rate in the US. The bonus comes at distribution time with the foreign grantor trust. And the reason is because you've established a taxable basis in the account, come retirement age, which is either 60 or if you've retired and or over the age of 65, you meet what's called a condition of release. You're able to withdraw your superannuation account and you're not paying any additional tax on the US side because you already did throughout the life cycle of that fund. Employee benefit trust treatment is a bit different. So the contributions are taxable as they always are. In reality, they don't, I don't think you often see the contributions truly changing the tax outcome, but it is technically taxable income. The reason why I have that nuance there and say it's taxable income, but you don't end up paying tax on it is because of this. The foreign tax credits that you're generating on the income that you make in Australia more than offset this additional income that you have, which is a small amount, could be as much as $30,000 that you have going into super. It's probably not going to result in an additional bill. So that treatment from the foreign grantor trust and the employee benefits trust is the same. So it's technically taxable. In reality, it doesn't end up being taxable. But here's the kicker with the employee benefits trust. When it's in your superannuation account and growing year to year, there's no tax bill to pay. However, the chickens are going to come home to roost at that liquidation event when you begin to draw on your super. And that's because you've got no taxable basis in the account. And I have to be honest here, it's really the expertise of an international CPA to determine quite what your basis is in the superannuation account. The assumption from the ATO is that it's nothing, which, excuse me, the IRS is that it is nothing. I misspoke there. The IRS are going to look at that and say, you don't have any taxable basis in this. Therefore, all distributions coming out of your employee benefits trust are taxable income. So we don't like that. The way that tax practitioners have to work here is a little bit like fumbling around in the dark. There was an opportunity in 2022 when a case, Dixon and his I'm not tax counsel. That's the nicest way I could put it. John Anthony Castro took the tax commissioner to court but that got thrown out. So we don't have any precedents, any actual formal precedents that we can rely upon. So instead, we're using analogical reasoning from domestic trust law, private letter rulings, informal IRS correspondence, revenue procedures. None of them carry the weight that a ruling from the tax court would provide. Okay, so getting back to the next slide here, the two exceptions I wanted to mention, one of which is I'm going to arm you for a conversation with a cross-border CPA. So that's this highly compensated executive exception. This is a rule that applies to US qualified retirement plans. And so you can see the Section 40 category, like 401k, for instance, is in a related section. This is a test that US retirement plans need to go through, but there's no feasible way for your US tax return preparer to possibly contact your Australian super fund and say, I need to know if this is deemed a top hat. That's the fancy term that's used. If this is deemed a top hat plan by virtue of them being an imbalance of highly compensated employees. Chances are that it's not. If it's an industry fund, I would say your tax preparer could look at the average Australian incomes and make a case there that it's probably not going to be highly compensated. But my point is, it's practically impossible to obtain that information anyway. The second point here is for self-managed super funds or self-directed accounts falling, they do not have this exemption from filing a 3520, and that 3520 is a form to do with trust distributions where one trustee is an American individual. So yet again, self-managed super funds are really terrible from the point of view of the IRS. So the decision drivers, as is indicated here, is really who controls the investments and who funded the majority of the contributions. Bill Lyons, good to see you here. If you have evidence of 15% tax on concession contributions and Div 293 tax bills, surely that gives you a taxable basis. I'm not so sure, to be honest. As I mentioned a moment ago, Bill, this is a known unknown to me because it's like Alice in Wonderland type logic, a world of bizarro kind of things. So the taxpayer of that is not technically deemed to be you. So it's considered to be the fund. So I really do not feel qualified to comment on that one. It's a fair point. You know, one would think that that would apply, but I do know that there have been cases that have been thrown out on those very points. Okay, let's get into detail here then. So foreign grantor trust versus the employee benefits trust. The triggers, as I mentioned, you're looking at a foreign grantor trust if you contributed more than 50% of total contributions on a personal basis. That's not your superannuation guarantee contribution. Member retains broad discretion over investment composition, as I mentioned before. So the US tax consequences, it's a disregarded look-through entity. Contributions are taxable in the year that they're made, as well as on a mark-to-market basis on an annual, with your annual tax filings there. The news gets worse. I don't think you could imagine it being worse, but we see the 3520s are due, 3520As are due, 8621, which is that's your PFIC form, passive foreign investment company form, subject of another couple of webinars, just talking about that very topic, but that relief is not offered when you have a foreign grantor trust. So all of the investments within your super fund suddenly need PFIC reporting as well as the penalties that arise from PFICs. So it's just an absolutely horrible outcome. Employee benefits trust, I definitely prefer the employee benefits trust in client situations where it's not certain that they even will be a US tax resident at distribution time. The one major benefit I think you get from the employee benefits trust, quite aside from the deferral of taxation through the growth years, is if you can somehow exit from the US, like this is particularly relevant in the case of temporary visa holders, if you can retain the employee benefits trust while you're a US tax resident and then exit the US because you're no longer on your E3 visa anymore, you're done. You never had to really worry too much about super in the first place. Employee benefits trust treatment gets a little more complicated for your permanent residents and citizens because eventually the chicken will come home to roost and we're going to need to figure out what that taxable basis is. So what do we have here? Nothing I haven't said already. Plan is non-discriminatory. I mentioned in practice you can't even prove that. You could just dig up some statistics and say, listen, this is a government-run program. Everyone is required to be in it. As a result, we should look at average wages and make a determination that way because with a plan like Australian Super, the super fund company itself, they literally have millions of members, and there's just no way in the world that they're going to produce that IRS requested report. So taxation is deferred until actual distribution, and that's kind of where the planning opportunity is. So if you know roughly what your US taxable income is going to be in retirement through the distribution of IRAs or pensions or whatever the case is, then you would add super on top of that balance because it's going to be US ordinary income taxable. A couple chats in here. Nancy, what does control over investments look like? Selection of a fund. It's another one of these ambiguous, excuse me, another one of these ambiguous points. That's not totally clear cut. I would say if you have a uh, essentially like a Hub 24 super account where you've got total control and discretion over all the individual investments, that probably meets that discretion test. If, however, you're defaulting to a retail or industry funds options, which may include a dozen, balanced, conservative, growth, whatever, where it's this broad selection of investments, then I would say that would probably be fine. Ramina writes in and says, "This is interesting because my tax agent treats the 15% as a claimable tax." All right. Well, Ramina, welcome to today's webinar. And the reason we don't believe it's a claimable tax, and there's cases that exist on this very topic, is because it's not you that's paying it. It's the super fund that's paying it. So I'll leave that to you to take that up with your tax agent. Bill Lyons again, interesting, especially when the ATO gives you a 293 bill at year end. Uh, that's a fair point. You know what? You might be onto something with the 293. Not with the contribution, not with the 15% contribution, but the 293, because you're right. That is that is levied individually. So there may be foreign tax credits that you could pick up on form 1116 with that. Okay, let's keep going here. So the savings clause preserves full taxation rights over citizens. Savings clause override. Here's that Dixon case study. It was thrown out anyway, so we can't really take many lessons from that. It would have been wonderful, by the way, if that had been ruled on, because I think it's well, firstly, it's a highly controversial case, and I had nothing to do with John Anthony Castro, but the point, I think there's some validity to it. Is Social Security, excuse me, is superannuation a privatized version of Social Security? If that was the case, then there's all sorts of ramifications and repercussions from that. As you see here, unresolved legal risk because the only judicial test of the privatized Social Security defense was dismissed. We don't really know what the IRS absolutely, positively, for sure thinks about these things. But if I were you, I would take note of this slide right here. This is something I've taken a screenshot and included in client notes because I'm going to come back to it again and again. So we're looking at the life cycle tax treatments of superannuation from the US point of view, depending on whether it's grantor or employee trust. So what do we see? The 12% current taxable income, as I mentioned. Voluntary concessional contributions, well, it's the same thing. It doesn't reduce your US taxable income. It's also taxable compensation. But remember, that's where, oh, you know what? Oh, I just thought of something. Salary sacrifice is Is a loophole. Okay, so I'm glad you all joined me here today because this will be a real value add. The research that I've done suggests that a salary sacrifice, because it's not you that's writing the check, it's deducted from payroll, does not contribute to that 50% personal contribution. So that's a way around it. But remember, you can make personal concessional contributions. That is where you EFT money over directly to the super fund. That is you making that contribution. If it's salary sacrifice, that's different. That's considered employer contribution. So this is an advanced practitioner way of growing one's superannuation balance. Is that desirable to do in the first place if you're going to end up paying ordinary tax on it in the end? Maybe not. But in certain client cases that I'm thinking of where the idea is to exit the US by the time you distribute, then retaining employee benefit trust treatment and growing that super account as much as possible is very much the idea. Okay, non-concession contributions, again, it's taxable income. Oh, hold on, not subject to current US tax. Well, let's think about that. I guess it wouldn't be because you've already paid tax on that Australian income. You've got a foreign tax credit, which is offsetting it on the US side. So correction, non-concessionals would not be tax deductible on the US side. They also wouldn't be taxable because they've already been taxed. Accumulation earnings. Okay, here's the big difference right here, and that's why that's bolded. There's the mark-to-market treatment. So every year you're looking at what the balance was on January 1st versus December 31st, whatever that difference is. Congratulations. Add it to your US tax bill on Form 1040. Employee Benefits Trust, don't need to worry about that. But your super fund, don't forget, they do have a concessional tax treatment within the super fund itself. So you are paying 15% on short-term gains, 10% on long-term gains within the fund. Heck of a lot better than the 47% that we see outside of superannuation. As of July 1st, we've now seen this inflation indexed approach that the Labor government has introduced or reintroduced, I should say, back from the late 1990s. So that's a much preferred environment to have your retirement savings is within superannuation. All right, lump sum distributions, it's tax-free on the Australian side, same with income streams whenever it is that you meet a condition of release. But here's where things turn on the US side. So it's a tax-free return of capital for a foreign grantor trust. So that's good news. But bad news is you had to pay that additional income probably during your highest income earning years. So that's why we don't like that so much. Don't forget, by the way, the immense hassle and cost of being compliant in your tax filings if you've got PFICs and 3520s and 86 28s and so forth. Taxable is ordinary income on the portion exceeding the documented cost basis. The timber trap. I didn't look up the background of why they're called the timber trap, but it makes me think that it's like timber, the old-fashioned movies where the person, the log cutter, cuts the tree and then suddenly it all falls at once. That's what I guess that's the visual. That's the thought that came to mind there. Next, pension income stream distribution. It's taxed the same way as any other annuity. You've got an exclusion. What that means with an annuity is there's some amount, a quote unquote investment in the contract. That's your taxable basis, and the amount in excess of the investment in the contract is what you're going to be paying tax on. There's a chat here, Mike Robinson. If contributions are treated as current taxable compensation, can you include it on the excluded foreign income calculation? Well, this goes back to what I was saying before, Mike, and it's a very complex topic, so I don't fault you for the question, but I did mention you don't end up actually paying tax on this, even though it is treated as taxable income. The reason you don't pay it is because of the big difference between the Australian marginal rate. So you're looking at 47% versus the US marginal rates. And I was just doing a calculation of this last night for some reason. And if you're making 500,000 Australian dollars, that's equivalent to 350,000 US, which puts you in a married filing joint bracket. So you're paying 47% on the Australian side, and on the US side, you're paying 24% at the federal level for married filing joint. So in other words, you've got this enormous 23% delta between your US marginal rate and your Australian rate. So you're generating these huge foreign tax credits, which you're probably never going to be able to use, but that's what's making it such that your super contributions don't actually change your US tax bill. So this it feels a little bit like trying to describe light. Is it a wave or is it a particle? In this case, I'm saying it's superannuation is thanks, Bill. You got it. It's both. It's it's gosh, I lost my train of thought. That was funny. So it is taxable income, but do you actually end up owing tax on it? No. An important caveat to hold on to there. All right, let's keep moving along here. So why foreign tax credits? By gosh, I wish I had come to this slide sooner. Well, fund level 15% tax is paid by the trustee, not by you. The individual didn't pay or accrue the tax per Section 901. The IRS position is entity level tax is not allocable to individual creditable taxes. And thus, no bueno. However, Bill Lyons, Mr. Relativity there, did raise a point, and that is if your Div 293 surplus, that's if you made over $250,000 and you have to pay this bonus 15% contribution tax, might that not be creditable? And I tend to think it would be because you are paying it, so it defeats this argument. All right. Division 296. Oh, this is more on the update slide. And by the way, it's easy to get confused between Division 293 and Division 296. 293, higher income earners making more than $250,000 pay a bonus 15% contribution tax. Division 296, which had a lot of press in the past 12 months. We haven't heard much about it in the past 3 months. It's still awaiting royal assent, but I think it's set to pass this one. Basically, if you've got a super balance in excess of 3 million, then you're looking at paying a 15% realized tax, a 15% tax on realized gains above that portion that is $3 million. So your total rate ends up being 30%. Why? It could be 25 actually, because 10% long term, 15% short term. So we're just saying 30% would be your highest rate, and if it's above 10 million, that would be 40%. I'm just going to tell just a brief story because it was funny and remarkable. And that is, was it 3 or 4 years ago? I was at a Financial Planning Association breakfast, and the Minister for Financial Affairs, I think it was, or was it the Deputy Minister? Bill Shorten seems to be the name that comes to mind. He was talking about this change. He was going around getting opinions and just getting the word out there about what's coming. And one of the advisors in the room put his hand up and said, "Well, I've got a client who's got this unbelievable sum of money." I could barely believe what he said. He had a client with a super fund with something like $500 million in there. And it was it was absolutely amazing because the minister called him out and he said, we know who your client is. You're the guy." That was a very small world, returning to Australia and realizing a minister can actually know the individual taxpayer because it was thought to be the highest balance in a superannuation fund. On the same topic, just as a quick aside, Peter Thiel, the controversial US billionaire, he has something unbelievable in his Roth IRA. I think the number I recall is $20 million or something like that in a Roth IRA, which when you're dealing with annual contribution limits of $6,000 to get 20 million in there is quite astonishing. I think the story was that he had a self-directed one with early stage Facebook stock or something like that was the story. Anyway, enough with those interesting side stories. So let's move on, shall we? Division 296, just be wary of that. You're looking at a realized gain tax. More changes, payday super. I think this is a tempest in a teacup. Really nothing to see here. Essentially, contributions to your super need to be made in a timely manner with your pay. So none of this quarterly contribution, as was the case in prior financial years. Transfer balance cap has increased. This is worth talking about. If you're not familiar with what the transfer balance cap is, then I would suggest you do pay attention to this. So I'm often saying to clients, you win the game of superannuation if you get your balance to what's now $2.1 million. And why is that? And that's because you enjoy the tax trifecta, like at the Melbourne Cup or something. You win the tax trifecta. You get tax deductible contributions in the form of concessional contributions. You may have been able to make non-concessional contributions, so you can get up to 100. What are we up to? 130 is the annual limit on non-concessionals plus 32,500. So $162,500 per year is the max that you can get into super. Grow that to 2.1. It's growing at concessional rates, as we saw a minute ago, 10% long-term, 15% short-term. And then if you roll it over to the pension phase, distribution phase of your super account, well, you're in for a treat because that amount is going to grow tax-free. Once it's on the pension distribution side, it's tax-free, and it's going to come out tax-free. In the investment world doesn't get better than that. That's just fantastic. So is it a bad place to hold more than 2.1 million? No. It's still a tax advantaged environment. You're paying tax at a high rate of 15%, assuming it's below $3 million. So it's still a desirable environment, but there may be other opportunities, and I might yet do a webinar on this, an asset class that's really come into focus following July 1st of this year and the changes to capital gains treatment in Australia is what's called an investment bond. And investment bonds are interesting, kind of based off the old life insurance legislation. And the idea is that you pay in to a contract. You actually need to pay in once, but you can pay in every year. You have to pay in at least 100% of the prior year balance. And I think there's a cap, 125% max of the prior year as well. And then after 10 years, there's no additional taxation owed. So you just pay the company rate of tax throughout that 10-year accumulation period, and then it comes back to you tax-free. So that works great if you're not a US tax resident, which of course most of us on this call today are. But it would hold relevance to people who are planning on getting rid of their permanent residence cards or surrendering their citizenship. So lots and lots of words on this slide. I don't mean to put you to sleep just before lunch, but I just wanted to talk through a strategy that I had looked at. I got really excited about this one before I sent it off to my tax attorney to get her second opinion on it. And it turns out it doesn't work. So the idea here is I thought, well, what if you intentionally opted for a foreign grantor trust? You kept it PFIC free, so that would essentially mean individual stocks and term deposits. That's going to avoid complications with having PFICs in there. What if you then used your your excess foreign tax credits, which are otherwise stranded, and you met that mark-to-market tax every year with your foreign tax credits that you've been accumulating on your Form 1116, I should say. And then at retirement, you've got a fully stepped up superannuation account, and you can continue to be a US citizen, US tax resident, doesn't matter. You're getting your super out tax free because you've used your foreign tax credits to shelter that mark-to-market gain. Well, it turns out it doesn't work. And here's why it doesn't work. The Tax Reform Act of 1986, where they introduced what in Australia we only introduced in a partial form in the most current financial year. back in 1986, the US introduced different types of income. They said, we're going to tax different types of income differently. There's going to be categories. So there's ordinary income category, and there's other categories. There's passive category as well. So where you're generating a foreign tax credit with on the ordinary income side, you cannot use that to offset passive income. So that is what strikes the death blow on this particular strategy is you've got stranded foreign tax credits stuck on the ordinary income side that aren't helping you with the passive category. That's a real shame. So we're kind of back to the employee benefit trust approach in the meantime. Exit and distribution strategies. What do we have here? So it really boils down to this. This is, of course, there are more advanced strategies that we employ for clients, but this is not a client presentation. This is a public presentation. And I have to say, we do hold the best strategies kind of closer to our chest. So for non-US citizens, the super recontribution strategy, and I've done webinars on, in fact, the April webinar was on precisely this topic. So if this is of interest to you, then go take a look at that. So let's say you terminate your US residency, however that happens, either you move back to Australia or surrender your green card or go through the process of completing a Form 8854 to relinquish your citizenship and be done with the US tax system altogether. That happens, then you send a waiver off to a W-8 Ben, off to your investment custodian. Typically, it's remarkable. You know, as I mentioned, I heard Schwab just this morning. They said you got to submit your W-8 Bens to prevent over withholding, and I just got choked on when I heard those words because they still withhold. They still withhold at 30% as if it doesn't apply. And so that was a very unusual thing for this lady to say. But nevertheless, she said the way it works in practice is the following year, you just submit your Form 1040, you include your W-8 Ben, you'd say I was over withheld, here's what happened, and then you get your money back. That's how it works. And I have only got one client case, and there's other extenuating circumstances that she's got where she's running into some difficulties with the IRS, and it's not related to this 1042S, the 1042S being the form that you need to substantiate the over withholding. She had other prior year tax situations that made things more complicated. Okay, and then you make it back to Australia, and oh, sorry, before that, step three, determine your taxable basis. Hopefully, you were a client of mine, and you were planning well in advance, and you took steps to get a step up in basis before you moved. Then you could distribute that nearly free, if not entirely free, of Australian tax and commence a recontribution strategy into super. For US citizens, unfortunately, none of that is possible. Why? Because of the savings clause, correct? None of that's possible. So it's really just a case of minding your P's and Q's, knowing what your US taxable income is going to be, and then layering your superannuation withdrawals on that so that you can manage to a certain tax bracket. All right. SMSF pitfalls. This would be a good one to screenshot if you have an SMSF. It's just consider each one of these bullet points a nail in the coffin. There's just so many things that go with withholding a self-managed super fund and being a US tax resident. It doesn't work. It's not allowed, and you get smashed with penalties. So don't even think about it. I think what's happened is every now and again, I will get a prospective client who is talking about their SMSF, and maybe I'm too strong in my wording, but I tend not to hear from them again because maybe I presume that they decide it's easier to go to ground and try and be ignored than it would be to come to compliance. US compliance and reporting requirements matrix. So this is another very helpful table that I have here. So your APRA default fund, this is going to be your Australian Retirement Trust, Australian Super, CBUS, that kind of thing. Likely exempt from the foreign trust reporting, that's 3520. 86.21 for PFIX, don't worry about that. And then 88.33, that's the treaty reporting, likely exempt as well. So what is required, as you can see there, self-managed super funds. What's got a bit more reporting is if you do hold an APRA retail arrears fund and you've contributed more than 50%, that's when things get a little bit trickier for you because it's become a foreign grantor trust. There's a bunch of penalties. I'm always at pains to say almost all of this additional reporting is exactly that. It's reporting. It's not paying additional tax. It's the US will slap you with some serious fines if you fail to tell them about something. But if you tell them about it, then and you've paid the appropriate tax already, no harm, no foul. There's no problem. So why wouldn't you just report exactly what you've got? Next month's webinar, actually, excuse me, next quarter's webinar. I've gone from doing these monthly to quarterly. How do US inheritances with Australian beneficiaries work in 2026? I'm pleased to say I learned something very, 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 very valuable, and all my clients who are present on today's call, I'm sure, will be asking me about this when we speak next. And that is, as of last week, straight from the horse's mouth, as of last week, Schwab International now allows TOD and beneficiary nominations on their accounts. That's wonderful news because previously the advice had been you need to obtain a US will to deal with your US Citus investment or retirement account. That's no longer the case. You can actually specify the beneficiary right there, and that will deal with that in short order. So November 17th, same time, same place. Please join me then. But while we're together, let's hear some questions from folks. That didn't take long for Phil Montgomery to get his out. So you're saying that managed funds are okay to own in an APRA? Well, no, not so fast. I was not saying managed funds. I was saying those broad investment options. So I don't mean the Platinum Asia Fund as an example of a managed fund. I mean the conservative investor option or a target date option. That would be a fund that would, I think, would be pretty safe from the end investor expressing too much discretionary authority over. So not normal managed funds, default investment options. So Phil was quick off the mark with that question. Any other question? Or people just so spellbound? Susie Benton's got her hand raised, but that's probably an accident. Um, People are just okay. Ron's getting his out. He's typing. Kylie writes, so interesting to say that self-managed super fund is a no-go. Well, it absolutely is. And honestly, I tell you that there are some things that I have been saying my entire career, and self-managed super funds I've been leery of before I even started as a financial advisor. So for 20 years. And here's the thing is if you look at the costs involved, you need, I would say, $2 million thereabouts before it's even economic to have a self-managed super fund. So heavens forbid if you have some international complication to your situation, then it really doesn't make sense. But yeah, I just I don't see the point. I just don't see. Okay, Krista, I work in the US, have dual citizenship, and don't plan to return to Australia, but my super is now in a bank. And you plan on taking it 15.5 that is closing its Australian business. You know what? I'm aware of that voyage. I was under the impression I would pay tax. Well, coincidentally, we have someone else on the webinar today who's in exactly that situation. I was under the impression I would pay tax the amount if I transfer it to the US through the same bank. Well, you will if you transfer it to the same bank, but if the fund is taken over by another fund, that should not be deemed a distribution event. You've got no control over that. It's just something that's happening in the background. So, Krista, maybe you want to write and just further clarify that because I'm not totally sure what you're getting at there. I mean, it seems to me like everything I've described in today's webinar would suggest that you're looking at paying ordinary income tax on your super distributions. And if you're going to stay in the US, that would seem highly likely. Michael, can you briefly go over how Australia covers transfer from 401k traditional to traditional IRA, same thing. You might want to clarify that. Okay, there is some difference in opinion. If you're still in the US at the time that rollover happens, then the ATO doesn't get involved in that. If you're in Australia, however, when that transfer happens, that's when practitioners seem to differ on their opinion of that one. I have historically thought that that was not a taxable event, but recently a couple CPAs that I work with have said, "Oh no, no, that can be taxable. That can be challenged as a distribution." Can it though? I'm not totally sure. But Mike, I think that gets to the essence of your question. Joel, what does re-contribution mean? How do you do this? Well, Joel, good news. These slides, these presentations are recorded, so you can go back, and actually even better than that, as Mike Smith asked at the outset, um, I've got my YouTube channel there right at the top of the chat, and the very last presentation I did in April deals with that in a great amount of detail. So you will see what that means. It's essentially to do with getting your money out of the US and into superannuation. Would you ever do that in reverse? Would you ever plan on some sort of recontribution strategy out of super and into a IRA or 401k? I don't think so, and it wouldn't work anyway because those are those are tested by employer contributions and payroll contributions, so it wouldn't even be viable. Kathy Barnsley writes, I am not a high income owner, but I do want to comply with tax laws. Okay. I am a dual citizen living in Australia and have a self-managed super fund with my Aussie husband. How do I navigate this? Oh dear. You get in contact with your international CPA, not your not TurboTax, not H&R Block, but a specialized US international CPA who can help you get into compliance there. Ron, so for the normal class of retiree with a small super, we should just treat it like an IRA. Distribution is taxable income in the US. Pretty much, yeah, that's right. If we were to summarize it, then that's what I think you would conclude. Krista Hammond, it is not in a fund anymore. Okay, well, where is it if it's not in a fund? So is it still in the superannuation environment? Because if it's been distributed, it's all done. It's over. It's that there's been a taxable event that's already occurred if it's not in super any longer. Bruce, if you're withdrawing 5% annually from your super account, how is this distribution reported to the IRS? I don't think it's on your ATO tax force. No, it's not. That would be your 1040. It's the Section 72T, not T, Section 72 annuity type distribution, where you're looking at whatever your investment in the contract is, your taxable basis, and the growth you're paying ordinary income on that amount that is deemed to be taxable uh, above the basis. Kylie, my husband is a US citizen and Australian permanent resident, high income earned from stock only. We've realized a lot of our stock and put it into an SMSF here in Australia. Now I'm annoyed. What if we put the SMSF entirely in my name? Uh, what if we put the SMSF entirely in my name? I'm a US citizen only. Okay, my husband is a US. Well, I don't know if your situation changes any, right? If you're both US tax residents, then it doesn't improve much. I would say, without knowing you, Kylie, and this is general advice because we do not give specific advice on these public webinars, but if that's all that was in a self-managed super fund was a bunch of low basis stock, why have it in a self-managed super fund at all? Why not just have it in some other, it would still be a foreign grantor trust, but you wouldn't have some of the other nasty reporting requirements. You could have a directed super account with Hub 24 or Net Wealth, or someone like that, and you can have your stock just fine. There'll be no problems with it at all, and you don't need to worry about all the reporting and nonsense that goes with a self-managed super fund. Krista, not in the super environment. Okay, now I understand. Thank you. Sorry, yeah, no worries. So it's already happened. It's been distributed. Taxes already happened. Jason's here just to re-clarify. If you've declared your super TP, what's that? Super what? Super TP to the US as income for tax purposes each year, um, and not self-interest funded. Your accrued foreign tax credits should offset the capital gains when you start taking distributions. Definitely not. No, that is not what I said. If you've declared your super as income for tax purposes, you've got stranded foreign tax credits that are not being used, and they do not offset what income you're getting paid from superannuation. Bill Lyons, thank you, Ashley. I feel like I need to read a Tough to know to cheer myself up after this one. See you soon. Yes, indeed. Jason says to the okay. I see. If you have declared your super to the US as income for tax, well, my point stands, and that is no, the foreign tax credits are stranded as ordinary income, don't offset against passive. So there's no luck there. A couple of folks have written into the Q&A. Brett Batty, if you've left the US and renounced citizenship but still get a very small amount of Social Security, do you still have to do a US return every year? No, you don't, Brett. And you know why? Because I've done one of the 100 videos that I've done is on exactly this topic. Instead, there's withholding of 25.5% that the US does, and they consider that tax paid. You're all done. Have a good day. So that's the sitch with what you described there. Michael Wall, dual Australian US citizen living in the US, currently taking super distributions. If I convert back to accumulation phase, the dollars put into another fund until they start taking distributions again. Would I be subject to capital gains tax at the time the money is transferred from distribution phase? Wow, what a question that is. That one's never been asked before. I don't know what the point would be though. So it's already in the distribution phase. And for some reason, why exactly? I don't know. But for some reason, you're talking about moving it from the distribution phase back to the accumulation phase. I don't know what the tax treatment would be. I would hazard a guess to say um, there might not be anything on the US side, but I just don't see what the point would be if it's already being distributed. You know, the facts speak to the situation. I don't think there's a lot of planning that remains to be done in a situation like that, Michael. It's just it is what it is. I always find it amusing when the basis of the word accountant, the reason why accountants generally, not there are some exceptional accountants out there that do engage in planning, but the reason that accountants aren't planners is inherent in the word accountant, and that is it's impossible to account for something that hasn't yet happened. Accounting, by definition, is you account for what has happened. And this is an example of that. So you need to speak to your accountant to figure out how best to make sense of that situation, Michael. I'm afraid I can't be of any more assistance there. Kafka rules, yes. Nancy, following Bruce's earlier question, reporting of super pension US, where would I find the documented USA basis? You know, that's an accountant question, that one. So I think today's webinar, if nothing else, gives you the knowledge to have a more informed conversation with your accountant, where you could say, okay, here's how I understand the tax treatment of such an account to operate. Where is it on the 1040 that I complete this? And a better question, I'll leave you with this because I'll be here all day otherwise. The better question to ask your accountant is, what creative strategies can you offer me in order to justify a higher basis in my superannuation account? I'll say that again. What strategies or opportunities can you offer me to justify a higher taxable basis in my superannuation account? Because the higher the basis means the less amount of it that's taxable. If you can somehow justify a high basis, then you've got less tax to pay. All right, everyone. Well, hopefully I'll see you in November for this estate planning webinar, but otherwise be well. And I just ask, don't keep me a secret if you know of someone that we may be able to assist. Have a wonderful day.